On June 1st, a silent shift in global finance is accelerating beneath the surface, and most investors have no idea it is happening. For decades, commercial banks controlled the arteries of money creation, savings, lending, and liquidity distribution, but now an entirely new ecosystem is emerging outside the traditional banking system. This ecosystem promises passive income, automated yield generation, and global access to capital 24 hours a day. And, if this trend continues, it could fundamentally alter how liquidity moves around the world. The question is no longer whether decentralized finance exists. The real question is, how much capital is quietly migrating into these alternative systems, because every dollar that leaves a bank reserve system changes the mathematics of liquidity, and liquidity is the invisible fuel that powers modern economies. When liquidity becomes trapped, entire economic systems can begin to slow down. Historically, central banks fought liquidity traps with lower interest rates and aggressive monetary stimulus, but decentralized liquidity pools operate under an entirely different set of incentives. Instead of waiting for banks to offer returns, users can seek yield directly through digital networks. That shift may sound technical, but its implications are enormous. Banks depend on deposits because deposits support lending activity. When deposits decline, lending capacity can weaken. When lending weakens, economic growth can face new headwinds, and when enough capital leaves the traditional system, policymakers begin paying attention. What makes this moment unique is the speed at which technology can redirect money. Smartphone and an internet connection can now compete with parts of the banking industry. That reality is forcing financial institutions to rethink their long-term strategies. Some institutions are attempting to adapt by building digital asset infrastructure. Others remain cautious as regulatory uncertainty continues to evolve. Meanwhile, global currency markets are beginning to monitor these liquidity shifts closely, because whenever liquidity moves across borders at scale, exchange rates rarely remain unaffected. The decentralized liquidity trap begins when capital enters alternative networks but stops circulating through the traditional economy. Money may still exist, but its location changes everything. This is where the story moves beyond technology and enters the realm of macroeconomics. Every economy depends on the velocity of money. When money circulates quickly, growth tends to accelerate. When money becomes isolated inside closed ecosystems, growth can slow despite abundant wealth. That possibility has become increasingly relevant as digital asset markets mature. Large pools of capital are now capable of operating outside conventional financial channels. For central banks, this introduces a challenge. Few models were designed to handle. Traditional monetary policy works best when most liquidity remains inside the banking system, but alternative liquidity networks may respond to entirely different incentives. The result could be a growing disconnect between policy decisions and capital behavior. That disconnect has major implications for interest rates. It also has implications for inflation, and, perhaps most importantly, it has implications for currency stability. Exchange rates are ultimately driven by supply, demand, confidence, and capital flows. If global investors discover more attractive yields elsewhere, money tends to follow, and where money flows, currencies often respond. This is why foreign exchange markets are paying increasing attention to digital capital migration. A decade ago, these flows were too small to matter. Today, they are becoming increasingly difficult to ignore. Institutional investors are no longer merely observing these markets. Many are actively building exposure to emerging liquidity ecosystems. That shift alone could reshape capital allocation strategies over the coming decade. And it may only be the beginning of a much larger financial transformation. This content is for educational purposes only. It is not professional financial advice. Investing involves risk. Always do your own research.